Good morning. This is Larry McMillan with a stock market update on Monday, October 10th. Well, the market made new relative lows again last week, gapping down on Friday, not to a new low on Friday, but we're moving lower again today, and it does appear that the lows are probably going to be violated. There is tentatively right now support near those lows around 3,600. Below that, you'd have to go back to the fall of 2020 to find maybe some support around 3,500 to 3,550. The overall trend of S&P is bearish, of course. And if we were to move down and touch the lower trend line, which we last did in June, now that would be around 3,200. So that would be a substantial decline from current levels. Meanwhile, we are beginning to see some oversold conditions again. We had some, they got worked off a little bit. Now they're building up again, but that's typical of a bear market. We had these oversold rallies, which carried back about to the 20-day moving average and then failed. So that's what happened to the last one. And in any case, let's review the indicators. We do have a McMillan volatility band buy signal right now. That's not doing well, of course, but that's a more intermediate term thing, so it has a chance to resurrect itself later on. Equity only put call ratios are technically bullish because they rolled over, but now they're starting to move higher again, and if they were to move to new relative highs, that would cancel out those recent buy signals. Meanwhile, the total put call ratio never did actually give us a buy signal at all. Breadth has been very poor in the last week, and the breadth oscillators are both on sell signals, and they're both in oversold territory. What's a bit interesting here is that we've had a number of 90% days in both directions recently, probably more down than up, but still both directions. And we've written articles about this in the past, and in general, an increase in the frequency of 90% days is a negative for the market because it indicates things are getting more volatile, and a more volatile market is usually a bearish one. So that's just something else causing a problem for stocks. New highs, again, very low in number, 19 on Friday on the New York Stock Exchange, so that indicator remains on a sell signal. VIX has kind of been holding back a little bit. It rallied at the end of last week, but not strongly. But now this morning, October 10th, it's moving higher. And if it closes above 31.55, that will stop at the most recent short-term volatility spike peak buy signal. Meanwhile, the trend of VIX continues to be upwards, and upward trending VIX is bearish for stocks. And that's the intermediate term indicator that turned bearish back in mid-September. Finally, the construct of volatility derivatives also is modestly bearish, not tremendously bearish, in that the futures term structure, VIX futures term structure, and the term structure of the CBOE volatility indices are sloping downwards now, at least in the front end. So overall, we're maintaining our core bearish position. We will trade confirmed buy signals or any other signals really that are confirmed around that. But so far, the buy signals have been short-lived, typically being stopped out pretty quickly. So I invite you to visit our website, take a look at our daily newsletters so you can keep up to these things on a more frequent basis. And meanwhile, have a great week trading.